What if life happens and you can't make payments anymore? This happens on occasion, where one has a plan to maximize a whole life insurance policy. I know how much I can fund the policy for the next 10 years or forever, and this cash value buildup is going to look fantastic. But then something comes up, perhaps I have zero control over the situation, and now I can't fund the policy as originally planned. What's going to happen to my policy? What if I make things worse and I say, I've got a loan outstanding on my policy as well, and I can't make payments like I thought I could, and I can't pay the loan interest? What are my options? This can happen. What we're going to look at in today's video is a case where this did happen. This will be based on an actual policy, someone who started his whole life insurance policy a couple of years ago. They've made 2 full payments. So they started back in 2020. They made the first payment, max funded it. You'll see the amount is $85,000 per year. Second year, they max funded it. Third year, they only paid the minimum. They also have a large loan outstanding now. They had a major life event occur, and the original plan of funding it at $85,000 per year is out the window, or at least on hold for perhaps a number of years. So in a situation like this, it's very important to keep in touch and really review different options, because what I want to make sure of is A, that the policy does not lapse, but B, that we don't neglect anything. For example, does it make more sense? So say this is you. You can't fund the policy at your original planned amount of $85,000 per year. You also have a loan outstanding. In policy year 2, you needed a loan for $80,000, a little bit more, and you're looking at your policy and saying, okay, do I continue to pay the minimum premium or do I pay just the loan interest? Because I'm not in a situation where I can do both, at least not right now. Which one is truly in your best interest? Seeing those options really allows you to see numbers and make an informed decision so you don't make a move and then find out after the fact, I should have done something differently. So we're going to look at that. We're going to look at just that today. So again, original plan, $85K per year, had a major life event occur. He cannot fund the $85,000 per year anymore. And he also needed a loan. This had to do with the major life event for a little bit more than 80 grand. You'll see his loan balance is presently right around $85,000. Now, in a conversation with him, he did state that I may be able to resume payments in the future. However, that is not something I want to lead with. Because think of it, if this is you. You're in a situation where you're probably really stressed out because you've got things going on. Yes, you might be able to make payments in the future, but that's not something you're really concerned about right now. You're concerned about fixing the present problem. So let's address that present problem by looking at options. And we will look at this, resuming payments, but we'll do that at the end of this video. So number 1, he's got a loan outstanding. What does it look like if I don't make any loan payments? So if I pay just the minimum premium and I do not pay the loan, what does that look like? We're going to look at funding that minimum premium up until the age of about 60. You'll see the illustrations and such. But we'll look at making 0 loan payments so he can see what that looks like. Then we'll look at paying interest only. What does it look like if I pay the minimum premium only and pay the loan interest? But then what does it look like if I stop the premium, meaning I pay nothing, I don't pay that minimum premium and only pay loan interest? And you'll see you can actually pivot back and forth between those two. And then what does it look like, again, if I pay the minimum premium and repay the loan, and then stop premium payments and also repay the loan? And then lastly, can he add more money later? So for example, what if this is you? You decide to attack the loan right now. Can you elect to resume payments? Let's say your life turns around and you say, you know what? This is behind me. I can fund the $85,000 per year. Can I start doing that again? The answer is yes, if the policy is designed properly and if we've got everything set up to still accommodate the funding, meaning the agent has to make sure that that's still possible. And it's important to ask questions throughout the process. So when preparing these types of illustrations, we do need to run in-force illustrations, and I'll let you know this right up front. This can be very confusing when you look at these on paper, and here's why. So he's in policy year 3. I'm going to show you his past year payments in a second here, but he's already paid year 3, and all he funded in year 3 was $8,300. Years 1 and 2, he paid $85,000 because he had planned to fund the policy aggressively, and he started out of the gates strong. So year 3, he's already paid. Here's his loan right now, just about $85K. That's outstanding. Now, when you look at the net cash value, here's what it's illustrated to hit at the end of policy year 3, $88,000 and change. Now, this illustration is showing what? Look at your net after-tax outlay, $13,100. Here, you've got after-tax loan interest. So what's going on here? This $13,100 assumes the minimum premium of $8,300 plus the annual loan interest payment. So this is one in-force illustration of the many we're going to look at that assumes I pay that minimum premium plus the loan interest. Now, what I'll add about this is that his true minimum premium is a bit lower than $8,300. This includes the base premium plus the cost of the term rider, but he could lower that to just the base premium only, which is $7,000 in his particular case, but then he could sacrifice some PUA flexibility. So for the sake of this example, I kept it at the $8,300, knowing that we do have options. And it's going to be a conversation piece as well as we talk through the different options. So let's begin with this, more of a worst case scenario, no loan payments. So what we're going to look at, we've got the in-force illustrations, but let's actually look at this instead. We're going to simplify things a bit. Well, first, we have what actually happened. And again, how we obtain this is through the annual statements and such, because he was curious as to what the policy had produced during the early years. He wanted to see, hey, what did I pay in the policy in the first year? $85K. My cash value was $75,000 and change. Okay, that's great. Year 2, he paid in the $85. Later on, he had to take that loan out, $84,000 and change, which is why his net cash value after the loan is accounted for is $75,842. So what do we have here? Year 3, we know he's paid that, $8,300, but he's got an outstanding loan of $84 and change, and in this example, going to assume that he does not pay the loan interest. So with a life insurance policy, if you don't pay the loan interest, what's going to happen is when it comes due, it'll actually take a loan against itself. It's going to borrow against the cash value, which will impact the performance negatively. You will not see it grow as fast, which you'll see that when we look at the paying interest only option. But you'll take a loan against the cash value. You'll see your death benefit impacted as well. How much is it decreasing by here each year? Look at that, the amount of the loan interest. You get a big drop here in year 8. That was optional. We cut the term rider. However, we're still funding the minimum premium. And we do that through the age of 60. So this is an example demonstrating what the policy will potentially look like. If he pays 0 loan interest, he funds the premium just through age 60. He can continue to make payments longer if he wants. But in this example, we're going to assume stopping at 60. And what do things look like? Continues to increase, but eventually what happens? Well, that loan balance is getting heavy. The loan interest is getting heavy as well. In green, we have our net cash value, which again reflects the net cash value that he has access to accounting for the loan. So the outstanding loan balance is factored in here. If you see your cash value begin to decline when you're not paying the loan interest, that is a result of the loan interest exceeding the total earnings on the policy. Now, in this case, we don't hit the danger zone because by the time he hits 100, you're going to see it start to shoot back up again. That's if he's still going at age 100. But generally speaking, we don't want to see a case where that cash value goes down where we're not paying anything. However, it is very beneficial to see that. If this is you, would you rather see a situation where I didn't show this to you? Or you get to see this up front to see, okay, if this happens, if I don't make any loan interest payments, here's what can potentially happen long term. Thanks for that info. How can I prevent it? Well, there's several options. One thing you could do here is turn the dividends on or apply the dividends toward paying the loan interest. Right now, we just have them reinvested into PUAs because we're still paying the premium, but there's different options that are available. With that said, let's look at paying the loan interest. So what we looked at there, no loan payments, more of a worst case scenario. Let's look at paying loan interest only. So what we have here are the two scenarios we had highlighted, which are what? Pay the minimum premium plus the loan interest, and then stop premium payments and only pay the loan interest. Let's begin with this one. Pay minimum premium and pay loan interest. So, identical chart over here. If we pull up the in-force illustration, it's exactly this. We just exported it to Excel. But there's the premium, $8,300. Oopsie daisy. There's the loan interest, and there's the interest payment. These two match because each year when that interest comes due, it assumes that we are paying it. All right, fantastic. This will look good as time passes. The reason why is because we're covering the drag in this particular case. If we're paying the loan interest, the policy does not need to take a loan against itself to cover the loan interest. Now down here, we do see a drop. The reason why is because this policy is with Guardian. This is a policy that was issued with a guaranteed rate of 4%. So how it works is at issue, you've got a fixed rate at 6%, but at age 65, which you'll see down here, or I'm sorry, it's age 65 or 20, whichever one comes last. So we started at 48, year 20 is later than 65. So 20th year. The fixed rate drops to 4%. What happens here is if you're paying the loan interest, they actually apply a discounted rate, which we are assuming the interest is paid out of pocket in this example. And what some people do here, one might say, hey, if I'm going to fund the policy through age 60, can I pay the loan interest up until that point and then stop? Yes, we can look at that as well. And it's something we want to track as time passes. Over here, what do we got going on? Stopping premium payments altogether. So this displays what has already been paid in. Now in year 4, which begins June of 2023, we assume he stops premium payments, but he does pay the loan interest. And what happens over here? Here's really what I would want to know. If I pay the loan interest, I dish out $4,800. What's my net cash value growing by? Because the net cash value, that's my money column, what I have access to. Well, here's the answer. Net cash value growth each year. What's interesting about this, paying just here we're paying nothing toward premium. What happens to your cash value growth for a couple years or several years? It still increases, but it's increasing by less each year, meaning year 4 to 5 is less than what it grew by the prior year. The reason why is because I've got a premium over here that's still due, but I'm not paying it. I also have a term insurance rider attached that I'm not covering. So the policy is supporting the premium plus the cost of the term rider. It's still increasing, but I see a little bit of drag until we eliminate the term rider here. We also executed a reduced paid up in this illustration, but now I can see what? My annual cash value growth is greater than the interest I'm paying out of pocket each year. So here's a nice option where I can see what it looks like if I pay the loan interest only. Let's take a look at repaying the loan in full. So same thing regarding the funding. What I mean when I say that is we're going to look at funding the minimum premium through age 60 and then stopping altogether and what it looks like when I pay it in full. Which he did state I might be able to do this, or I at least would like to see what it looks like if I stop funding altogether. So here we go. Fund it through age 60. There's my loan. This example assumes each year you pay the loan interest that comes due, plus you apply $20,000 per year toward the principal. And again, we just pulled this directly from the illustration. And same thing over here. or similar, stop the funding altogether, meaning no more premium payments, but now I'm just going to redirect all of my resources toward the loan. So each year I'm paying the loan interest and applying funds toward the loan principal. Now what he can do, if he says, okay, each year I want to make sure I pay the loan interest, $20K per year is too steep to apply funds toward the loan. Let me pay just the interest, and then each year I'll pay what I can toward the principal. He could do that if he wants to do so. What's nice about this is here I can see how much he paid in here. We all can. So year one, 85. Year two, another 85, which gives you a total of what? 170. Plus another 8,300. So what's his total payments at this point in time? 178,300. When that loan is repaid, we see the cash value restored to what it would have been as if I never touched it in the first place. What do you notice here? 196 and change. Does he have more in the policy than what he paid in? Yes. Pretty sweet, isn't it? And then the cash value continues to appreciate over time. Why he's seeing positive cash value so early is because he stuffed the policies in the early years. One of my favorite things when it comes to designing a whole life insurance policy is really planning for this, because we can't anticipate this, right? Life's going to happen. It's often out of our control. When life does happen, though, when we look at policy design, if I've got a low premium, the policy will not feel like a burden. So in a case like this, his premium, his true minimum premium is what? $7,000. Now we have it at $8,300 covering the term cost, but that's his minimum there. And then everything else was going into PUAs. So in the event that life happens, and I say I want the policy to be able to pay for itself, fund self. Now, instead of having to cover a big base premium, I've got the minimum only, which prevents a situation where I see my cash value go backwards. What it also does is allow me to maximize the cash value right out of the gates, because if I have a lower premium, more of my money goes toward the PUA rider, which gives me more cash value and puts me in a situation where I don't have to worry about, again, my values going backwards. So that was repaying the policy loan that we just looked at there. And then let's wrap up with his last question, which was, can I add more money later? And the answer is yes. So what we looked at here was first just a performance review, and we backed out the loans here. This shows paying the minimum forever. Right, so here, loan was paid off in this example. Cash value 173,194. Going back to this, 173,194 in policy year 3. So we've got no loan outstanding, and I can see what things look like moving forward. Breaking even between years 4 and 5. He's breaking even between years 4 and 5 with paying the minimum only because he max funded it in the early years. First 2 years, that's the key. If someone has the ability and actually follows through and max funding a policy in the first and second year, you'll see in almost every case, you put yourself in a situation where you almost can't lose. Unless I just stop paying and I borrow everything out and the interest will exceed the earnings. But if I heavily fund it in the first 2 years, I could stop funding altogether and I'd see a break even very close to what we have here between years 4 and 5. So if one has the ability to do that, they're in a very good position, which he is. So this displays just the minimum indefinitely. The question was what though? Can I add more money later if I want to? Because he did ask that. So let's take a look. The answer is yes. Here we go. So just to kind of throw some variety in there, because he asked this question. However, from a discussion standpoint, we didn't discuss too many specifics because he's more concerned about what's going on and not being able to cover the minimum and the loan interest. Just show me different options regarding the loan. This is great to look at for the future. So what we've got here are a couple things. And again, we can include this with the loan. I just backed out the loan and assumed it was paid off right away for simplicity. Here's what's already happened. He's paid that in. Year 4. We're assuming he pays just the minimum. And then beginning year 9, I remember running this. I meant to illustrate that at 85 per year. It doesn't really matter. So ran 80K per year. if he wanted to assume max funding it for a while. And it could start this earlier or do it later. It just demonstrates if it takes me a while to get back on my feet, well, here's a nice demonstration displaying I can pay just the minimum and then scale it back up later. And then the same thing over here. Well, not the same policy, a little bit different, minimum this year, and then kicking it back up to 40. And again, this does assume that the loan was paid off in policy year 3 in this example. But this demonstrates options that are beneficial to see when life happens. And these are nice to look at beforehand, but the thing is, when I say beforehand, just, hey, here's what it looks like if you take out loans and life happens and you can't pay anything back. But what's very valuable is seeing what it looks like as time passes after something happens, because things do happen. And we've seen it happen to individuals who have policies where they're funding 85 grand per year, with some individuals funding 6 figures per year. We've had individuals funding policies with 7 figures per year, where they plan to heavily fund it for a long period of time, but then they scaled back because they wanted to redirect their capital elsewhere for some time. They can always increase the payments later. My point is, regardless of your situation, if a policy is designed properly, you're in a situation now where you've got a minimum premium, so it does not feel like a burden. And if we've heavily funded it, especially in the early years, now we're in a good position where the policy can even take care of itself for a while, sometimes forever if we do things right. But anyway, hope you enjoyed this video. Please let us know if you did. If you have any questions, feel free to leave them below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.